To understand overbillings, we have to understand the motivation behind them. In front of us, we have activity from one project that started in 2023 and finished in 2024. In 2023, we had billings of $45,000 and costs of $10,000, leaving us a gross profit of $35,000 with a gross profit percentage of 78%. Fast forward into 2024, when we complete the project, we had billings of $2,000 and costs of $27,000, leaving us a gross loss of $25,000 and a gross loss percentage of 1250. Now, when we combine the activity between the 2 years to show the project from beginning to end, we see that total billings were $47,000, total costs were $37,000, with total gross profit of $10,000, with a gross profit percentage of 21%. Now, what you'll notice is the significant difference between the ending gross profit and the amount of gross profit we recognized in 2023 and the amount we recognized in 2024. We have huge swings from one year to the next. 78% one year, negative 1250 in the other. However, we end up landing at 21%. Now, the purpose of overbillings and underbillings is to stabilize revenue recognition so we avoid these sudden fluctuations, because it is misleading. If I were to show you 2023, you would think we had an excellent year, knocked it out of the park, did really well. If we go into 2024, you're going to think we're going bankrupt, we're losing a ton of money, it's all over. But that's not exactly the case. So over-under billings come in to stabilize revenue recognition. So how do you stabilize revenue recognition to avoid these significant fluctuations? You use the percentage of completion method to revenue recognition, which states that you recognize revenue based on your estimated gross profit. Not just the activity of billings and costs, but your estimated gross profit. Now the question is, how do we recognize revenue based on estimated gross profit? Let's take a look. In this example, for simplicity's sake, we're assuming that our estimates were 100% correct. What we estimated was actually what happened. As you know, that's never the case. There's always change orders, cost overruns, maybe you save some money. But in this example, let's assume that before the project began, we estimated revenue of $47,000, estimated total costs of $37,000 with a gross profit of $10,000 and gross profit percentage of 21%. So how do we take this estimated gross profit of 21% and turn it into the actual percentage we recognize? Well, that's when the percent complete method comes in. One of the first steps in calculating gross profit based on the percent complete method is to determine how far along you are on the project. That is known as percent complete. You take the cost incurred through the reporting period and divide it by the total estimated cost. In our example, it's 27%. That's $10,000 through 2023 divided by the $37,000 estimated total cost. We are 27% complete on the project. We still have a long way to go to complete it. Now we take that percent complete and we multiply it by the estimated gross profit, which is $10,000. Once we do that, we add it to the cost incurred, which is $10,000. This is the same $10,000 that's in this formula here. We add it to the cost, and we arrive at the total earned revenues. This is how much revenue we should have recognized in order to arrive at a gross profit of 21%. As we see here, $12,700 is a lot less than $45,000, which is the amount we billed through 2023. So we're supposed to recognize less revenue than we did before. How do we do that? Through overbillings. Okay, if your cost to date plus your estimated gross profit to date is less than your billings, you have an overbilling for the difference. That means since this amount, the amount that the percent complete method is telling us to recognize in order to arrive at the 21%, is less than the amount billed, we have an overbilling for that difference. We are $32,300 overbilled on the project. We've billed way ahead. Or in other terms, we recognized a much higher gross profit percentage than we estimated. A good way to demonstrate this is to look at the percentages side by side. Here we have the amount recognized just based off of billings and costs, and to the right is the estimate. You can see 78% is far higher than 21%, meaning we are overbilled. We are recognizing a higher margin than our estimate says we should. So that tells us, just comparing the two, that we are overbilled. Now, something to keep in mind, just because your billings are further along than your costs, it doesn't mean you're overbilled. In this separate example, we had billings of $75,000 and costs of $56,000 with gross profit of $19,000 and gross profit percentage of 25%. Well, if our estimate is 28%, we are underbilled. You can see the difference here. It's flipped. Instead of being overbilled, instead of the actual gross profit based on billings and costs being higher than the estimate, it's lower than the estimate, which means we are underbilled. If you have any questions on that, you can watch the summary on underbillings in a separate video I made. Now the question still looms. How do we actually get to recognize gross profit based on estimated gross profit? Here's the mechanics behind it. So assume you're this guy here. You're standing on top of the actual gross profit based off of billings and costs. And you're trying to get to this step here, which is the estimated gross profit. You've got a long ways to go. You can't just jump to this level. You need something to bridge the gap. So instead of just falling into the pit, overbillings help you get from the actual gross profit you were recognizing to the estimated gross profit. It gives you a platform to do so. It essentially acts as the vehicle to get you to that estimate amount that we had to recognize. Now, what is this column here in accounting terms? Well, it's a liability. We're going to recognize a liability for that difference that we highlighted above there, the overbilling amount. We're going to recognize a liability on the balance sheet, a current liability, and the offsetting entry decreases revenue. Makes sense, right? We were recognizing too much revenue before, so we're decreasing it now to that 21%. It was 78%, now it's 21%. So we're debiting revenue, decreasing it. And in the process, we're increasing a liability. We're not permitted to recognize that revenue yet. It's almost like unearned revenue. We haven't incurred the costs. We haven't completed enough on the project to recognize the amount we invoiced, that $45,000. So you debit revenue and you credit overbillings for the difference between the billed amount, the $45,000, and the amount of revenue that we should have recognized. Now you may hear, Overbillings called something else. It's typically known as billings in excess of cost and estimated earnings, but for simplification, I'm calling it overbillings here. I hope that made sense. I'm sure I'll do another lesson explaining the different parts. But if you have any questions or comments, please leave them below. I'll see you in the next lesson.